Welcome back to Explain the Charts, everyone, and thank you for joining us today, September 24th, 2025, for a critical look at Ethereum, ETHUSD, after a week of dramatic price movements. Just this past Monday, September 22nd, the cryptocurrency market, and Ethereum in particular, saw a significant 15% plunge. This event triggered a massive liquidation bloodbath of over $1.5 billion, wiping out numerous leveraged long positions, as reported by CoinJournal. Analysts pointed to a combination of factors: investors taking profits after substantial recent gains, the expiration of leveraged crypto positions, and a broader slump affecting the entire digital asset sector. Interestingly, this downturn occurred despite recent news of lower federal interest rates, which typically signals a more risk-on environment, highlighting the unique vulnerabilities within the crypto market itself. Bitcoin also faced considerable losses, dropping below $113,000, underscoring the systemic nature of the market correction. However, a crucial nuance emerged. Institutional demand for Ethereum remained remarkably strong, with BlackRock's spot ETH ETF alone registering roughly $512 million in inflows during the sell-off, suggesting a divergence where institutional players are accumulating amidst retail panic. This mixed sentiment sets the stage for a complex analysis as we delve into the charts to understand what might come next for ETHUSD. Let's immediately turn our attention to the one-day chart to visualize the impact of Bloody Monday on ETHUSD. Here, you can clearly see the large red candle for September 22nd, which opened around $4,452 and plummeted to a low of $4,056 before closing at $4,205.30, marking a devastating daily loss. This stark visual confirms the severity of the 15% drop mentioned in the news, underscoring the intense selling pressure that dominated the day. The volume accompanying this crash was exceptionally high, indicating strong participation from sellers and a broad market reaction to the underlying catalysts. On September 23rd, yesterday, we observed a subsequent rebound attempt, with ETHUSD closing slightly lower at $4,165.19. This recovery, however, was on comparatively lower volume than the crash itself, suggesting that while some buying interest emerged, it wasn't as decisive as the preceding sell-off. The $4,000 level clearly acted as a significant psychological and technical floor during the Monday sell-off, preventing an even deeper capitulation. This level will be absolutely crucial to monitor moving forward, as its integrity holds significant implications for Ethereum's short-term trajectory. Now, let's zoom in even further to the 15-minute chart to capture the granular detail of Monday's liquidation cascade, providing us with a micro-view of this intense event. Specifically, if we narrow in on the period between 5:50 Universal Time Coordinated and 6:05 Universal Time Coordinated on September 22nd, you'll observe a single, exceptionally large red candle. During this mere 15-minute interval, ETHUSD plunged from approximately $4,293 to its daily low of $4,056, a rapid depreciation that speaks volumes about the forced selling from leveraged positions. This dramatic and sudden price movement perfectly illustrates the biggest liquidation cascade ever headline from CoinJournal, where a substantial amount of long positions were wiped out in a very short time frame. The extremely high transaction count and volume during this particular candle underscore the frantic trading activity and panic selling. Following this initial, sharp decline, the chart shows subsequent attempts at consolidation, but no sustained buying pressure immediately emerged to reclaim higher ground. This rapid price discovery and the lack of an immediate V-shaped recovery highlight the severe shock to market confidence during these critical hours. For day traders, such swift movements can be incredibly challenging, but also present rare opportunities for high-risk, high-reward reversals if accurately timed. Shifting our perspective to the current short-term outlook, several bearish signals warrant our attention. The news indicates that Ethereum accumulation has stalled, with institutions and whales reportedly moving ETH from staking platforms to centralized exchanges. This movement typically increases the available supply on exchanges, contributing to potential selling pressure and a less favorable supply-demand dynamic. Furthermore, network activity remains subdued, reflected in extremely low Ethereum network fees of just 0.17 GUI, which is in the 6th percentile range, signaling weak on-chain demand and usage. On the one-day chart, the general sentiment remains cautious. ETHUSD has struggled to establish strong higher lows since the crash, indicating underlying weakness. Technically, the market appears fragile after breaking a key symmetrical triangle pattern, which analysts like Michael Van de Poppy suggest could lead to a measured downside target near $3,560 if selling persists. Immediate resistance bands for ETHUSD are clustered between $4,220 and $4,360, and failing to reclaim these levels would reinforce the bearish short-term narrative. A decisive break below the critical $4,000 support could accelerate the decline towards $3,800, making these levels vital for traders to monitor. Despite the recent bearish sentiment, the long-term outlook for Ethereum is supported by several robust bullish arguments, painting a more optimistic picture for patient investors. The significant institutional demand, evidenced by hundreds of millions in combined inflows from large managers like BlackRock and Fidelity into ETH ETFs even during the sell-off, underpins a strong vote of confidence in Ethereum's future. Many analysts view dips around current price levels as attractive accumulation opportunities for long-term buyers, suggesting that smart money is looking past short-term volatility. A clean bounce and a decisive close above the 50-day EMA, currently near $4,250 on the daily chart, would significantly improve the odds of a sustained recovery and signal renewed bullish momentum. If the $4,070 pivot level can hold firm, the path to retest the psychological $5,000 mark reopens, representing a substantial upside from current levels. Some prominent analysts, such as Ted Pillows, are even predicting ETH could reach between $18,000 and $20,000 by 2026, driven by broader macro trends, continued institutional flows, and the accelerating tokenization of real-world assets. These projections suggest that while short-term challenges exist, Ethereum's fundamental value proposition and ecosystem growth remain strong, attracting significant long-term capital. Therefore, strategic accumulation during periods of weakness, as observed with institutional players, could yield substantial returns over the next year or two. For active traders, navigating the current ETHUSD market requires precise execution and a keen eye on key price levels. On the 15-minute chart, as we move into September 24th, immediate short-term support appears to be forming around $4,120, with minor resistance near $4,180. A confirmed break above $4,220 would be an initial bullish sign for short-term traders, potentially opening the door for a push towards $4,300. Conversely, if ETHUSD breaks below the $4,100 mark, it would likely revisit the critical $4,000 psychological floor, where significant buying interest or further liquidation pressure could materialize. From a daily perspective, major support exists at $4,000, followed by a stronger zone between $3,550 and $3,750, including the 20-week EMA. On the upside, key resistance levels are found at $4,220 to $4,360, and then the more significant $5,000 mark. Always monitor trading volume. A breakout above resistance on high volume is a strong bullish signal, while a breakdown below support on heavy volume confirms bearish momentum. Look for specific candlestick patterns like hammers at support or shooting stars at resistance, which can signal potential reversals. Implementing tight stop losses for short-term trades is crucial in this volatile environment, and scaling into positions rather than all at once can help manage risk effectively. In summary, Ethereum stands at a pivotal crossroads following its Bloody Monday event, presenting a complex interplay of short-term caution and long-term optimism. For the immediate future, holding above the $4,000 to $4,100 support zone is absolutely critical. If sustained, a rebound towards $4,250 and potentially $4,360 holds a 60% likelihood, especially if ETF inflows continue to underpin the market. However, a decisive breakdown below $4,000 could lead to a swift descent towards the $3,550 to $3,750 range, including the 20-week EMA, with a 70% probability given the recent market fragility and technical breakdowns. From a long-term investment perspective, the outlook remains significantly bullish. A retest of $5,000 is highly plausible, 75% likelihood in the coming months, if institutional accumulation persists and market sentiment improves. Further out, ambitious targets of $10,000 and even $18,000 to $20,000 by 2026 are on the table, carrying a 40 to 50% likelihood, contingent on sustained adoption, favorable macroeconomic conditions, and clarity in regulatory landscapes. Key factors to monitor are the continued strength of institutional ETF inflows, a measurable increase in Ethereum's on-chain activity and average network fees, and any significant shifts in global monetary policy, particularly from the Federal Reserve. Prudent risk management, adapting to both macro and micro market signals, and understanding these critical price levels will be paramount for anyone trading or investing in ETHUSD during this fascinating period.